Welcome back. You're still watching FinWeek Money Matters. Remember, this is the show that helps you manage your finances. Long-term investors in the mining sector have had a pretty rough ride, delivering its worst performance over the past 5 years since 1966. The JSE's top 10 resources index fell almost 40% in 2015 and some 55% over the last 5 years. Yet many miners continue to try and sit it out or hang on by their fingernails. Well, this is according to the Rio Tinto Chief Executive Sam Walsh. Joining us from our Cape Town studio to discuss the state of the mining industry is Schalk Louw, Portfolio Manager at PSG Wealth. We've got Peter Major, Head of Mining at Cadys Corporate Solutions. And right here in studio with me, I've got Jason Muscat, who is the Senior Industry Analyst at FNB. Gentlemen, welcome and thank you so much for joining me. Let's start in Cape Town there. Schalk, it's been interesting because we've been talking about investors going through a very rough time. You are a portfolio manager, and given all the negative headlines that we've seen, job losses, impairments, what are you saying to investors at the moment who have maybe put their money into the resources sector?
Good day. Now, I think for a sector that has been extremely volatile and definitely not without risk currently, I'm sort of advocating to keep the emotions out of your investments. I think for now, we're sitting in a scenario where yes, commodities has been doing very, very badly, but we should always consider that the commodities have been coming off a very, very high, let's call it demand area, specifically from China's side, which hasn't been there for the past 3 years. So, and most probably won't be for the next 2 years.
Peter, let's bring you in here before we come back to Joburg with Jason. Peter, we heard Schalk mentioning China. We've gotten used to hearing that whenever bad news comes along. But would you say that this commodity downturn is just got to do with the price?
It's got to do with everything. Mainly there's a commodity downturn because we had too much production. All this new production came on, stimulated by high prices. And then a lot of those high prices and supposed offtake were artificial. They were artificially stimulated by low interest rates. They were artificially stimulated by Q1, Q2, Q3. So you had artificially high demand followed by genuine supply. And when that demand started fizzing out, what's all this extra supply going to do? But what made this run different than any other run is this is a bit like the Jonestown Massacre. Everybody drank poison Kool-Aid. So it's very hard to find any mining execs, any mining companies that weren't crowding around the Kool-Aid with all the poison interest rate, all the poison cheap debt. And that's what's made it so bad the world over. Now, in this country, we got a double whammy because we got a government and unions that also drank from the crazy Kool-Aid, and they've made it harder to run, let alone start a mine in this country than any other country on the planet other than maybe North
Peter, I'm
Korea.
going to stop you there because you were talking about the local mining industry here in South Africa. I'd like to get Jason's view on that, especially from the job perspective. Peter used very interesting analogies there about crazy Kool-Aid. Is there anything we can do for South Africa's local mining industry to get it right?
Well, we've had a very fractious labour environment, and you saw what happened in Marikana. The long-term effect of that strike still linger. And unfortunately, that issue forced the discussion of mechanisation. And until labour and the private sector, and indeed government, can get together and come to some agreement, we are going to continue to bleed jobs.
Schalk, let me come back to you. Again, I'm just talking about looking for value. An interesting column that you had on commodity prices, but you said that maybe now is the time to start nibbling at these resource companies. Really?
Okay, let's rephrase that part you said. I think the definite part is I am carefully optimistic. I think the whole theory around that research report that I've written was the fact, if you look at, everybody's talking about this super cycles nowadays, and let's for a moment say that super cycle is 100% correct. So then the previous super cycle was 1971 to 1999. Now, then your question must be, what was the low points back then? And that was 75. And if you say, what's a normal price that commodities should be increasing per annum? And I'm using inflation because a lot of people could use inflation plus because it's more expensive to put it in, more expensive to take it out. If you take just inflation adjusted prices from the previous low, then for the first time, end of November, let's call it December, the commodities prices, according to, if you take the IMF's all commodity index, was correctly priced. Now, if history is anything to go by, overreaction is more than possible. But I'm just saying, currently, clients or investors or readers that is currently still thinking of selling the commodities out of their portfolio should really be cautious, because we're now going into a value territory.
Right. I'm going to be asking more on this to Jason, but let me stay in Cape Town with Peter. Peter, next week is a big week. We do have the Mining Indaba that is going to be taking place. I know that you do attend some of these events, and you've been doing this for a couple of years. What are you looking out for? What's going to be at the top of the agenda, do you think, this time around?
Well, I think out of the 7,000 plus paid delegates, at the top of all their list is, who can we find who has some money that would be willing to put that money into South Africa and mining? I think that's what 99% of the people there are going to be looking for, top of the agenda.
Who would be willing to put their money in South Africa and mining? Jason, we did see quite a resource rally in yesterday's trading session. Resources were up, gold stocks were also up. Is this maybe the time, if you are thinking about resources, maybe leaning towards the gold stocks because times are so uncertain?
I would be hesitant to get into the sector at the moment. We believe that the trough will continue. China's recently pegged their growth targets at around 6.5% to 7%. Actual concerns are that the real number is weaker than that. So I think it's a little bit too early. We expect the trough to continue. I think we still have to see a lot come out in the wash. During the super cycle, there was a lot of industry consolidation, guys in the mining industry looking to consolidate their mineral portfolio. We're starting to see a lot of that being unwound now, where non-core assets are being sold off and a lot of shafts are being put on care and maintenance. So I think it's worth waiting just a little longer.
Schalk, let's come back to you. Of course, Jason alluded to some M&A activity. This is obviously something that you are watching. Just looking at some interesting activity, Sibanye Gold, and looking at those platinum assets and coal assets. Just your analysis on the trends that we're likely to see.
I think, if we look at over the last week, we've already seen Anglo's announcing that they are looking at maybe selling some of their core assets. So I reckon, mergers and acquisitions currently, specifically at these distressed type of prices that we're currently seeing, is definitely on the cards. I think 2016 is definitely going to be a year of a few reshufflings. You see nice words of we're going to go back to our core focus or core commodity focus. So I would definitely say mergers and acquisitions should be watched this year, especially at this distressed prices.
Peter, let me come back to you. You made an interesting point in the last conversation, or in the last answer that you gave with regards to who's going to put their money into South Africa. So if you could convince anybody, what would you say? What's the investment case for us right now, especially in the commodities sector? Yeah,
hey, it's easy to put together an investment case. We've still got 45% of the world's gold, the majority of platinum manganese. We just need government and unions to sit down with the mining companies and say, guys, we're doing this together. If the government and unions, and it couldn't be through the IDC, the PIC, if they agree to do a project, I know a lot of people with a lot of money that'll come here tomorrow. They just want the government and the unions alongside of them. They don't want to have a war with government and unions. Mining's dangerous and difficult as it is. If you have the unions and government on your side, we'll have massive foreign investment here and our mining can flourish again like it used to.
Jason, are there other parts of the world where things are looking a little bit better, or if you were maybe looking at investing? I know you said that you're a little bit cautious right now, but maybe the diversified miners that have exposure to other parts of or other regions of the world, does that change your view on the sector at all?
There's some speculation that there might be a bit of a bounce back in terms of diamonds, but with regards to most commodities, prices remain really subdued. One particular sector that we have seen a nice pickup in volume is the mining of building materials. And I think domestic volumes are increasing quite nicely on the back of the infrastructure, the development in sort of the gap housing segment that's taking place at the moment. It's not typically considered as part of your mining portfolio and the big attractive sectors like gold, platinum, etc. But when we're looking for positives, we'll take anything we can get at this moment.
Positive, so let's leave it there. Gentlemen, thank you so much. A big thank you to Skalk Low, Portfolio Manager at PSG Wealth, Peter Major, Head of Mining at Katie's Corporate Solutions, and of course right here in the Johannesburg studio, Jason Muscat, who is the Senior Industry Analyst at FNB. That's it for this week's edition of FinWeek Money Matters. Remember that you can go and get yourself a copy of the magazine. It is available at your nearest store, or you can go online and have a look at it there. We'll see you again same time next week. Have a great weekend.